Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
All right, folks, here's your U.S. markets wrap, where we've got some green on the screen, just barely, not a lot of conviction behind the moves. The broad market index, the S&P 500, up 0.4% to 6,045. And the broad market index now sitting less than 2% off its record. The Nasdaq Composite up 0.2%, and we've got the Dow Jones Industrial Average adding 0.2% as well, settling at 42,968. Some attention on the latest data around producer prices. The index for May is up 0.1% for the month after decreasing 0.2% in April. So that's kind of in line with what we saw with these consumer price index numbers as well. What else is going to be on the radar for investors to watch out for? That's going to be a conversation of Gina Martin Adams. She is the Chief Equity Strategist and Global Director of Equity Strategy for Bloomberg. Gina, how are you doing today?
I'm well, thank you. Thanks for having me on.
Great to have you on as always. So we've got a couple of things to watch out for in the coming days, and that's all around where the trade negotiations are going. It seems to be on a better footing these days as we see some signs of compromise. That 90-day countdown towards July the 9th might be extended. Is that going to provide some tailwinds or some support for where markets are going?
Yeah, I think the market is certainly priced for an extension of the 10% pause on tariffs, or even maybe 10% tariffs on every country except for China continuing into perpetuity. I think the shock that we would have is if that doesn't happen in either direction. So the upside shock could come if we get to day 91 and we actually have reduced tariffs relative to that 10% benchmark sort of level that does appear to be priced in the market. The downside shock, of course, comes if we don't end with an average tariff rate of about 10%. But our work would suggest that given the amount of downside estimate revision to analyst expectations, 10% is largely expected now.
Yeah, talking about downside risks, where's the U.S. economy right now? If you look at the latest data, PPI and CPI, you have them missing expectations, so not as hot as expected. So is that going to be good news?
It's early yet to say. The inflation numbers are still, of course, reflecting largely a pre-tariff environment and certainly not necessarily reflective of goods coming into the United States in a post-tariff landscape. That said, I think the state of the U.S. economy is muddled through. The most important numbers to watch right now are probably actually the employment numbers. As long as the U.S. consumer has a job and is earning a reasonable amount of income, as inflation remains contained, they can certainly start to see, keep up the spending progress in the U.S. I think the other thing to really consider with respect to the economic outlook, and this, of course, has derivative impacts on earnings, is what happens with capital spending. We have seen some pretty ugly surveys in terms of sentiment in the manufacturing space, and we will need to see those turn around to support a better capital spending environment to help that other side of the economy that is non-consumer centric.
Yeah, talking about the tariff environment, how much has that affected confidence among businesses in terms of hiring plans, budgeting, and so on? And domestically, there has been a lot of concerns around the use of the military for immigration enforcement as well. How much does that all factor into creating this risk-off environment?
Yeah. I think that the issues around immigration and utilization of military are very, very new. So it's way too early to suggest that that's had a material impact on business sentiment. We'll have to see how that escalates or de-escalates over the course of the next several weeks. In the short run, I think companies are still trying to plan, still trying to maintain operations, still, surviving just fine in an environment of 10% tariffs. Now that some trade with China has been reestablished, some of the smaller business strains a little bit less severe than they were just a few months ago. That said, what we see in the ISM surveys broadly is confidence has definitely taken a hit, and businesses are highly uncertain as to how the outlook is going to sort of play out. I think what they're watching now is what will happen with tax policy, reflecting the bill that's currently going through Congress. Can they get some incentives to spend to offset the disincentives to spend that are naturally emanating through the system with respect to tariffs is a key question for the very near term.
Yeah, talk about confidence in the U.S. economy and all things U.S. There has been a lot of talk about how foreign investors have been moving away from bonds and other assets, and that's to some degree put some pressure on the U.S. dollar. What are you seeing in terms of the data?
Yeah, I think in the equity market we saw this play out as well, especially throughout much of the first quarter and into the early part of the second quarter. We did see investors in Europe really putting capital to work in Europe and not necessarily sending that capital to the United States. We started to see some signs of flow shifting even in Asia in favor of Asian equities in the month of April at the very least, as well as into May. What we have not seen is U.S. investors start to send their money abroad. And I think to get some very severe downside pressure on assets, that's probably what it takes. For now, it's more of a mixed story. And I think it, frankly, as much as the world wants to point this as a policy issue or a political game, the reality is right now, U.S. earnings are projected to grow slower in 2025 than emerging market earnings, for example. U.S. fiscal constraints are preventing a whole lot of spending from bubbling up in the U.S., and monetary constraints are preventing the monetary body from reducing policies. That's not the case in global economies in Europe and China. So we have opportunities that are emerging in overseas economies that are not in the U.S. this year, and that's created a unique condition to benefit non-domestic asset prices over domestic asset prices in the United States.
Yeah, talking about pressure, we are seeing some pressure from Donald Trump on Fed Chair Jerome Powell. He's got some choice words. The latest is calling him a numbskull, trying to get him to turn down or at least cut the rates at a faster pace. Now, he's saying, with the inflation data that's come out, there is a stronger reason to do so. Where do you sit on this debate? Is that a good point here that he's making, that there is room to cut rates right now?
The Fed has a dual mandate, so they can't focus just on inflation. They also have to focus on growth. If the president sees that the economy is a lot weaker maybe than the Fed, then I think you could justify that the Fed needs to ease policy. But the Fed doesn't see the economy as particularly weak. The unemployment rate is still pretty stable. We're still adding a reasonable amount of jobs. And until that changes, the Fed has to focus on both growth and inflation. So inflation, yes, has come down, but growth also has not materially deteriorated. And until it does, it's hard to justify the Fed needing to ease a whole lot more. I think many standard rules of monetary policy right now, such as the Taylor rule, would actually suggest that the Fed already may be a little bit on the easy side. So will the Fed need to ease? I think it'll largely depend upon, their dual mandate, and growth is important for them to consider as well.
All right, so we've got a meeting next week. What are the odds of a cut there, and where are you expecting it?
I think most people are saying, look, we're not going to get a whole lot of change out of the Fed anytime soon. I think that's a reasonable expectation. They've even guided us to say that over the summer months, they're likely going to be data dependent and somewhat on hold. So I think we won't see a whole lot of action out of the Fed. We'll probably continue to see easing out of several other central banks, in particular in Europe, but maybe not the Fed this time around.
All right, just looking at the market odds, it does look like consensus is leaning towards a September cut more than June. So one to watch out for as we go down the road in a couple of weeks' time. So that's something to keep in mind as we navigate the markets. And we've got some help this morning with Gina Martin Adams. She is the Chief Equity Strategist and Global Director of Equity Strategy for Bloomberg. Gina, thanks for your time this morning. Always great chatting with you.
Thanks. Great to chat with you as well. Good luck out there.
All right. Catch up again soon, Gina. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.